2026 has been a wild ride. Artificial intelligence and SaaS stocks, which are software as a service, have been getting beaten up quite heavily. The US Iran war, oil prices, inflation creeping back up. The markets are even talking about raising rates now. Guys, the market goes up one day and falls apart the next. It falls apart, then rebounds midday. It goes up in the middle of the day, then falls apart. It's a wild ride, and some people are panicking. Some are trying to get rich quick, which is a very common theme in the world of investing. And then there are people like us looking at all this chaos and asking one question: where is the opportunity in all of this? So today, I'm going to show you how I'm navigating this market right now. And later in this video, I'm going to share a very specific stock that I think deserves attention. So the goal of this video is very simple. I want to give you a process. That's the goal of every single video we have. Something that any everyday investor can use. Not some Wall Street guru, not some hedge fund person. You have the advantage contrary to what people believe. And here's the thing that most people won't tell you. If you follow this process, you're probably going to end up wiser, smarter, and wealthier than a lot of the Wall Street guys with those Harvard MBAs and those MIT degrees. I'm also going to show you what I'm personally doing in this market right now. Not so you can copy me. I do not want that. I want to teach a process that allows you to think for yourself, to make your own decisions. That's how you will do best in the world of money. What I'm sharing are the thoughts and tools to help you do exactly that. And part of it's to say, hey, this is my world. This is how I view it. You might pull something from it in a positive or negative way that is different than you, and that's the main goal. But the very first thing that you should be doing right now is never, ever panic. I don't care if markets are up a ton, down a ton, never panic. Stop reacting to every news headline. Actually, don't look at a stock that's up 6% today and think maybe you should jump in before it does it again tomorrow. That's not investing. That's speculating. That's gambling. And please, don't let anyone, including Trumpy, tell you it's a great day to buy the market. Timing the market is one of the biggest disservices out there for everyday investors, and it builds a habit that will destroy wealth over time. So what do we do instead? Well, we block out the noise and we treat it like a normal day. If you're buying a low-cost ETF like SPY or VOO, you stick to your schedule, whether it's daily, weekly, monthly, whatever it is. Just keep doing it. Sometimes you're going to overpay, sometimes you're going to underpay, but overall, you'll probably pay the average. It doesn't matter what the news is saying. You buy at all times. It doesn't matter what your emotions are saying. You buy at all times. You do the right thing. Personally, every single month, on the first of the month, I buy SCHD. Now, I'm not endorsing SCHD. I do like it because it fits my goals. But my goals are a lot different than your goals. I've got 1,000 apartments. I've got multiple businesses. I have more than I need. So for me, it's about generating income to live off of. That way I don't have to take money out of my businesses and real estate that get really high returns on capital. And guys, I don't care what the month before is done. I still buy SCHD every month. Now, in full disclosure, I want to buy QQQ, but I'm not doing that right now because for me, I'd rather wait for prices to be a lot lower on QQQ relative to value. Guys, I'm not thinking about 2026. I'm thinking about 20, 30 years from now and how it makes the everyday person rich. That is my mindset, and that's the mindset I want you to have. Everyone, and I mean everyone, says they're a long-term investor until a new news article comes out. And guys, if you're new to the channel and you're not exactly sure what an ETF is, I put a card right here. We did a whole video breaking it down in plain English, so click this card and bookmark that video to watch later. Now, another thing I'm doing, I stopped checking my brokerage account unless I actually need to do something in there. Guys, in fact, a little anecdotal story from yesterday. I found a house in Cleveland, in a suburb of Cleveland that I was buying as a rental. The seller wanted proof of funds. And I was like, oh, I don't want to open my brokerage account and take a screenshot. Literally, that's how much I care about not checking my brokerage account because I know it's probably up higher than the last time I checked it, and I don't want to get that euphoric good feeling inside like, oh, I'm doing well. Just like if it was down, I wouldn't want to feel depressed about stock prices. That's what I understand for myself. It is difficult, but it's one of the best habits I've built. It really allows me to think long-term. You cannot say you think long-term and you check your brokerage account hourly, daily, etc. I don't want to get cocky when things are good, and I don't want to get depressed when things are bad. I'm here to buy a great company knowing that 10, 20 years from now, it's very likely that I paid a reasonable price. And as the fundamentals of the business get better, so will the stock. Now, another thing I'm doing is I'm looking for opportunities at all times, not based on a stock going up or down, but based on mispricing. Guys, a stock can be up and still mispriced and still be a value play. A stock can go down and be overvalued. I'm looking where I can find mispricing in stocks where price versus value is disconnected. I want price below value. I'm taking individual stocks. I run them through our stock analyzer tool. I make my assumptions on the future of the business for the next 10, 20 years. And then it will tell me, based on my desired return, what the company is worth to me today. Now, if there's a lot of green on that screen and it tells me, hey, you might want to take a look at this, I dig deeper. If it's a lot of red, then I sit there and say, okay, maybe I'll watch this, add it to my watch list. That way later, when it hits a certain price, I can go back to it and say, now it's making sense. Guys, I think the one thing this market has taught us is that great companies can fall in price significantly over a 1-year period. Now, as I mentioned earlier in this video, the market being down isn't bad news. Sometimes it creates a window. Look at the Magnificent Seven right now. So as I was just talking about, these are 7 great companies. But guys, this is their drawdown from 52-week high. Microsoft, down 31% from its 52-week high. Meta, 24%. Tesla, 23%. Amazon, almost 19%. Nvidia, 17%. Google and Apple, basically 13% down from their highs. Now, is that a lot? Some of these are. These are big numbers. But look how fast it happened. That's what I want you to remember. It's incredible. And just so you know, in about a week, I'm going to drop my update on the 7 stocks that I picked last year to go against the Magnificent Seven for the long run. And it's looking pretty crazy right now. So please stay tuned for that because it will be surprising what the results are. Guys, since this channel started 5 or 6 years ago, we've done so many stocks. And a lot of the stocks are great companies. And the number of times people have said to us, there's no way that company will sell for that low of a price, and it ends up happening, is mind-boggling. And we're not talking about crappy companies like those other idiots on YouTube promote, like Workhorse or Tattooed Chef or shit like that. We're talking about real companies. Companies like the Mag 7, companies like Nike, like Target. These companies where as the stock falls then, the story changes. Why? Because news follows stock prices. When stocks are down, the news justifying that comes to the surface. When stocks are up, they ignore the news that justifies a bad story and promote the stories that are good. Now, in addition to that, on our software, we have our near 52-week low screener. Automatically, guys, look at these names: Visa, Procter & Gamble, Home Depot, Novo Nordisk, Abbott Labs, Unilever, Stryker, Sony, Accenture, Progressive, Adobe. Guys, these are huge companies, everyday big names. This is a great place to start looking, not because prices are down, but because the market tends to overreact to headlines and create mispricings. It's a great place to start looking for value. A stock being down doesn't mean it's a good value. It means it's a better value, but it doesn't make it a good value. The advantage you have is when you look at this, you can sit there and ignore the headlines. You're not the one that's going to be panicking. You can be patient. You can come in and you can do the work. And we're not just jumping in because something looks cheap either. That's FOMO. That's not what we do here. We look at the price, we determine our value, we analyze them, and we compare them. And I'm going to show you exactly how I do that in a few minutes. Now, guys, take a look at this. Look at how many stocks in the S&P 500 have negative returns this year. Look at this. Incredible. We're coming all the way down 230 to 500. That's 270 stocks. Over half the stocks in the S&P are negative this year. It's incredible. Absolutely incredible. And look at this. What I think is even more incredible, SanDisk is up 185% year to date. Guys, we're not even done with month 3 yet. We're not even done with Q1. We're going to take some of these stocks. We're going to analyze them. We're going to use a process that doesn't require some sort of complicated accounting background or finance degree. You can absolutely do this. I'm not just saying that. You just need to be rational. In fact, I always tell people, look at a company the same way you look at your own personal finances. How much money is coming in? How much is going out? How much is left over? How much debt does it have? How much assets does it have? Does the future look brighter for the company or worse for the company? These are the things that you would sit there and try to determine. As an example, if you have a 25-year-old entering the market versus a 65-year-old that's going to retire, who has bigger growth and earnings power? 65-year-old or 25-year-old? Of course, a 25-year-old. They have much more to grow. Same thing I sit there and talk about with companies. A very mature, older company that's been around for a long time and is huge is not going to grow as much as a smaller company that's still getting some more momentum behind them. This is the way I want you thinking. If you can apply these principles that you do for your personal life to a company, it makes it a lot easier. Hey guys, it might take watching this video a couple times or going through more of our content, but I genuinely believe that everyday investors can do this. I just look at my friends and family when I talk to them about these things, like, well, how much money can you make? If I were to give you $1 a day for the rest of your life, what are the things you consider? How long are you going to live? How long am I going to live? How reliable is that dollar? These factors all are the same things you'd look at with any individual company. And like I said earlier, this is your first time here. I'm going to be straight with you. You're not going to find anybody else on YouTube analyzing stocks the way we do. Most channels just tell you a story, repeat a headline, and want you to follow along and buy what they're buying. That is the opposite of what we're doing here. Every video we make ties together for a long-term principle-driven investing approach, which is our framework that we use when we invest. We're always trying to find stocks that we can dismiss first so that we're not wasting our time and hard-earned money on the crap stocks. We want to find the ones that make sense. We are hunting for the real opportunities here. Between both of our channels, we analyze over 50 individual stocks every single month. And guys, in our community, they discuss thousands per year within them. I think last year we had over 8,000 companies and different companies analyzed over 1 million times in our stock analyzer tool. That's incredible. So guys, if you're new, I want to give you something free that's going to change the way in which you think about money. It's a cheat sheet so that as we get into stock analysis, you can follow along and understand exactly what I'm looking at. So pause this video, click the link in the description, download that cheat sheet, and follow along as we analyze this company together. So the stock we are analyzing today is good old Disney. Guys, Disney is a huge company with a lot of content, but here's what's interesting. So guys, before we go further, I want to be very clear. I own this stock. Do not buy anything because I or anybody else on the internet or in the world has it. I don't care if it's Warren Buffett. We're here to teach a process that you can apply. And guess what? We're going to have tens of thousands of people watch this video, and everyone's going to have a different opinion on Disney. Some are going to agree with me, some are not, and that's the beauty of investing. The great thing is, value investors can all do well buying the things that make sense to them. Now, Disney itself has been under pressure in 2026 because on March 18th, Josh DeMero took over as CEO from Bob Iger. And anytime there's a leadership change like that, the market gets nervous. Add in concerns about slowing theme park attendance, $4 billion in new debt to fund expansion, and a rough stretch for their entertainment segment, you've got a lot of reasons for investors to have concerns. On the positive side, Disney's streaming business is finally turning profitable. Their parks and cruise division remain a strong cash generator, and they sit on one of the most powerful content libraries in the world with Marvel, Star Wars, and Pixar. So the question isn't whether Disney's a great company. It's whether the price today makes it a great investment. And that's what we're here to find out. Because guys, I talked about principle-driven investing before. And the fifth and most important tenet, a great story becomes a bad investment if you pay the wrong price. And the flip is true. A bad story becomes a good investment if you pay the right price. I know it's hard to understand that, but if you focus just on the story, any price makes sense. Because whatever you do with the price, if you change it, the story is still true. It's about mixing the story and the numbers together. So, back here to Disney on the main metrics. Guys, it's a $172 billion company. Now, this is not to say the justification here is $172 billion. But if I gave you $200 billion tomorrow and said, go compete with Disney, I bet you'd have a hard time doing that with $200 billion. Doesn't mean then that you should pay $172 billion. But it means that this company has staying power, in my opinion. And they've got a great library of content. All right. So we've got returns on capital. They've been suffering lately. 5-year returns on capital are 3.5%. 1 year is 5%, hopefully getting better. We talked about that profit margin getting better, gross margin pretty good. Now, no acquisitions, but revenue growth, pretty solid for such a large company. 9.5% a year for the last 5 years. A big part of it was coming off of COVID and the parks being shut down. But even with that, 5.8% a year for the last 10, 4.3% a year for the last 3. So it's still a growing business, but guess what? Like my analogy before about a retired person versus somebody entering the workforce, this company's gonna have a hard time growing at double digits for long periods of time. So let's go check out. And by the way, I noticed that our community members have the stock as a hold. Interesting. 8 pillars, 4 checks, 4 X's. Checks are bought back a few shares, cash flows up in the last 5 years, net income's up, revenue growth is up, everything else is an X. Now I will say, long-term liabilities, they've got great assets, so I can accept that a little bit, and their free cash flow is still getting back up. So once that gets back up even more, hopefully this number goes down a little bit. And of course, our financial metrics of valuation, remember, their 5-year numbers are lower than their history, so this makes sense. So far, like even though it's a lot of X's here, there's a story behind that that kind of explains that. It doesn't necessarily put it away, but it explains that. In a couple minutes, guys, I will go over my assumptions about the stock for the future and comparing it to the price it's at today. So let's check out analyst estimates. Well, here's what's interesting. Analysts don't have a lot of upside for this company. $6.69 a share this year, growing to $8.32 in the next few years. High single-digit growth and revenue growth, about what I expected. Excluding the 7% here, 4.5%, 4.5%, 2.5%, and 1%. Guys, this is not going to be a fast-growing revenue business. But it's stable. It's got great content. It's got staying power. That's the big thing here. And that's what, to me, justifies a premium for this company. So now, we have a general idea of the story. We have a general idea of the numbers. We got to put them together. Let's go sit there. And this is what we do. We put in our stock analyzer tool. So let me pull up the last time I did Disney. Now, I did a 10-year analysis here. First off, revenue growth. I did 3, 5, and 7. Maybe that's high. Maybe it's low. I think that's reasonable, especially with inflation concerns, things like that. So I'm going to stick with that. Profit margin and free cash flow margin. I did 8, 12, and 16. Now, these numbers right here are higher than they've done the last 10 years, but their last 10 years have been very affected by the COVID shutdown, by Disney Plus, all the money they put in there. So hopefully they can get back to it. But here's what I'm going to do, guys. I'm actually going to alter this. I'm going to go lower. I'm going to do 8, 10, and 12%. I'm just going to be a little bit more conservative here. Now, what PE and price to free cash flow do I think the company sells for in 10 years? Well, guys, this is always one of the biggest questions we have from people. And I say to people, guys, in your head, start at 15 or 16. That's the market average. But go higher for good companies, lower for bad ones. Would you consider Disney a good company or a bad one? I consider it a good company. Yes, returns on capital are lower, but it's got a moat. It's got intellectual property. It's got a great theme park business that everybody in the world goes to. I look at this, I put 19, 22, and 25 for my earnings and free cash flow multiples 10 years from now. That's a lot, but I don't think it's a garden variety 15 PE or 15 or 16 PE. So I give it that premium. And then finally, I do a 9% intrinsic value return. No margin of safety in this number, but you have to have margin of safety. I just want to say, what's this company worth? Now, obviously, I'm not going to buy it for that value, but it's just to say, what is the company worth? If you've ever bought a stock, watched it drop, and felt sick to your stomach, you're not alone. This is why Everything Money built software that does one thing really well. It helps you figure out the right price to pay for a stock. The stock analyzer tool walks you through smart assumptions about a company's growth and cash flow. Then it shows you the price where you get the return that you're looking for. If you pair that with the 8 pillars framework, which analyzes the fundamentals of a company for you, and you stop guessing and start thinking like an owner, you are going to make better decisions. People who go through this process stop making the emotional decisions that cost money in the long run. They know what they own and why they own it. They sleep better at night, even when the market is doing something crazy. You don't need a finance degree to use our tools or to be a good investor. This was built for everyday people like you, not for the Wall Street gurus. So start a 7-day trial for just $7. Click the link in the description and get full access today. So I hit the analyze button. The stock's currently at 95. I have a low price of 75, a high price of 185, a middle price of 120. So guys, based on discounted cash flow model, the middle assumptions are about a 12% IRR. Is that enough for you? I don't know. Everybody's different. What's going to be right for you might necessarily be right for me. Now, there's one more strategy I'm using in the market right now. I'm generating cash on the stocks I already own, and I'm generating cash buying companies I love, like Disney, at lower prices. I'm being paid to wait. This strategy allows me to stay patient, keeps me in control, and lets me get some money on the cash I have in my account and the stocks I have in my account. So if you want to see exactly what I'm doing, click the video right here on your screen. Thank you for your time.